Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the stabilization of the housing market over the last few weeks and what that means for home sales and home prices. Logan, welcome back to the podcast.
It is wonderful to be here. Sarah, we did not have so much of a crazy weekend.
I know, nothing crazy happened on Sunday afternoon or Sunday night.
Now, I would say this. Last night, because of all the budget talks and tax cuts and the deficit's going to really grow over the next 10 years. By the way, all 10-year budgets do not assume a recession. This is why all 10-year budgets tend to not work in the long run. In any case, a lot of talk last night that the bond market, Sarah Wheeler, those bond vigilantes, they're going to see this tax bill and this deficit and they're going to punish us in the morning. I'm like, okay, all right. I'll see you guys all tomorrow morning. And we sit here right now. The last I looked at the 10-year yield was 4.24, 4.25. They came out again. They're really punishing us. They punished us because of the Moody's downgrade of debt and now the tax cuts. And once again, the bond vigilantes are nowhere to be seen. What was that character in McDonald's? The one that steals burgers or whatever? It was like a Zorro. Hamburglar, yeah. Yeah, that has more legitimate case than the bond vigilantes over the last 100 years.
I love it, Logan. Only you could tie in the Hamburglar to what's happening in the bond market. So let's talk about the tracker. It's been really interesting last couple of weeks. The tracker's always interesting, but what you brought up here was like, are we seeing a stabilization of the housing market? So maybe let's talk through that, what you mean by that.
So again, we have an unfair advantage because we're like months ahead of everyone. Right. And one of the things I've noticed is people who are not data scientists or not trained to read data, they take other companies' data lines and they don't read it correctly. So one of the things we always wanted to highlight with the tracker is that we have what we call slope of the curve economics. We take our active inventory, price cut percentages, new listings data, then we incorporate the 10-year yield and mortgage rates and purchase app and everything. And when the slope of the curve slows down, usually that means something has changed. Of course, my structural bias is that I'm loving this inventory. This big old grin of mine gets bigger when we get closer to 2019 inventory levels, and we were able to hit the bottom part of that this year. But the last 2 weeks, what do we know as a fact? Mortgage rates have been slowly moving lower, and we are not far away from the kind of the technical levels to where we've seen the data get better. And that's when mortgage rates go from 6.64% down to 6%. But what's different about this year than the last 2 years is that purchase application data, at least on the year-over-year data, has had 21 straight weeks of positive growth. The last 8 weeks have been double-digit year-over-year growth. So I'm waiting to see if we do breach under 6.64, do we have a similar aspect of what we saw last year? And last year, mortgage rates went from 7.5% all the way down to near 6%. And it changed our forward-looking data so much that we were like, oh God, we're going to have a couple 100,000 more home sales. My price forecast is going to be wrong. I'm going to be too low. I knew when that happened because our data months ahead of everyone else was telling us this. But for the last 2 weeks, the slope of the curve has slowed down, meaning that active inventory has slowed down. The price cut percentages have slowed down. The year-over-year growth actually has fallen down a little bit. And our weekly pending home sales data has hit a year-to-date high last week. Now, I'm throwing caution into this data line because over the next 2 weeks, July the 4th always causes havoc on weekly data. It really causes havoc on ours. But since it's going to be on a Friday, we're going to get a 2-week period where we don't have the normal traction of data. But going out in the future, because it's jobs week, right? If there was ever a time where yields can go a little bit lower, you're starting to get more and more people putting in rate cuts into the system now. We're below 435 on the 10-year yield. The 10-year yield mortgage rates are close to that level. If the spreads were normal, we'd have 6% rates today. So the market would handle everything better in that environment, but the spreads aren't back to normal. But if the data starts to get better, if rates fall, don't make the same mistake that everyone else makes when they look at old stale data and they have to wait 3, 4, 5, 6 months to go, what the hell just happened? We went from this, and I always use that November 9th, November, December, January, February, the structural housing dynamics had the greatest shift in history, where people went all hell bent on home sales falling to 2 million and home prices falling. Or like, if forward data gets better. So all I've seen is a stabilization in the data line compared to what we have been. And what is the one variable that's changed? Mortgage rates have slowly gone lower. Now, we're not at the year-to-date lows, but the year-to-date lows came in April when Godzilla tariffs just drew the 10-year yield down lower to where I thought we shouldn't have been anyway. But we could see the data pick up, and then all of a sudden it reversed higher. Imagine rates just going slowly lower.
Right.
And this data line gets better in the second half of 2025. And that's why the tracker was created. Whether it's positive or negative data, the slope of the curve of all of our data lines combined, you can see some of it working. And those that have access to the tracker could kind of see what's happening on that side. So it is exciting in that sense, because now that we're got to the bottom end of 2019 inventory, like I said, 29, when we get there, my low inventory talk goes away. Same talking points in the last decade, right? I'm not one of these low inventory, but post 2020, things were different. So we adjusted that. So we're going to get healthy inventory growth regardless of what happens. Even if rates go down and sales pick up a couple 100,000, we have good growth this year. But it's something to keep an eye on, because some of the structural dynamics could change like it has before, last year. At the end of 2022, the early part of 2023. So we would just want to keep an eye on that going out, but people can visually see just a little bit difference, even though rates are still above that 6.64% threshold that I've talked about.
So let's put this in more historic context, because as you said, I mean, when it comes to purchase apps, we're going against like the low of the low last year. So can you put this in context for like in general, before last year or before the pandemic, what does this level of purchase apps look like?
We're still listening to Gangster Paradise and No Doubt as a top song
So
singers.
what
So
does that mean?
we're still in the 1990s levels. It's still historically very low. It is no big material change, but it is a positive change.
Okay.
And this is where I think a lot of people make mistakes. Last year, the year-over-year data was not growing, but the weekly data were getting positive. So nobody made a big deal about it. They thought and then all of a sudden the pricing variable changed to get stronger, and home sales picked up a couple 100,000. So we're not talking about like the V-shaped recovery we saw in COVID. Remember in COVID, I think it was August of 2020. I wrote an article saying, guys, home sales are going to be positive this year. And half the people didn't even understand that we were already recovering in the economy, and housing made a V-shaped recovery. But because the forward-looking data was so aggressively high in the rebound, we were going to have positive. Nobody believed that. They were just like, this is nonsense. We're never going to. We ended up 300,000 higher. So we don't have what I call a big scale demand, but it is higher. All that's missing is the weekly data to firm it up a little bit. Just to give you an example, we have 24 weeks of data. 11 of it has been positive on the weekly side. 9 has been negative. 4 has been flat. But the year-over-year growth is the best we had in many years. I could explain that because this year rates fell. Last year it was running higher. And then the new listings data is higher this year. So as long as everyone realizes 70 to 80% of home sellers are buyers, when they get ready to sell that house, they fill out an application. So just think of it in that light. But it is growth. So we just want to keep an eye on this, because our freshest weekly pending home sales data almost had just very close to a year-to-date highs. And purchase application data takes 30 to 90 days before it hits a sale. There isn't an exact science of when it actually hits 1 month. Sometimes a month gets really big. Sometimes a month gets very little. But that's why the weekly pending sales data is showing just a little bit of growth. And again, if that occurs, we get a little bit of growth on home sales with elevated rates. The real question is, if mortgage rates go down to 6% again, how much can we grow sales from these record low levels? It's always been a couple 100,000 for just like 1 or 2 months. And in the last 2 years, I've already written the article in March. That's it. Home sales have peaked for the year because the forward-looking data was negative. We're not going to be able to get. It's not the case in 2025. And nobody wants to talk about it because I think so many people are confused when they see it. I had a Wall Street guy, really well-known Wall Street guy. He was like, oh, housing's crashing. Housing's there. I showed him the purchase application. He's like, what? They don't
They
know.
don't know.
They don't know because they don't follow the weekly data. So they have no idea. So it is the absolute shock that people have when they see the weekly data. Like, wait a second. I presented this to CBS News. And the CBS News people are like, what's this? But everyone is like, yeah, everyone's old, slow, behind. Home sales aren't crashing. We've never seen this in history. Whenever home sales are crashing, purchase application data is down double digits easily, right? Remember 2022? 2022 is a great example. It's like 35 to 42% year-over-year declines. I mean, and the weekly pending sales data just crap. It's not here.
I think charts are so helpful in this regard. So, for instance, I'm looking at the tracker, I'm looking at the national single family inventory chart. And it's just so clear when you look at that it says, 2025, we're up at this point 29% more than last year. But we're still so far down from 2019. Like, we're just at the very lowest levels of inventory in 2019. We've just reached that here. So that's the counter, and that's what's so obvious if you're looking at the chart to like, oh, this is a crash or what's happening. It's like we're really just trying to get back to normal.
Well, the difference is in 2005, active inventory NAR data was at 2.5 million. So it's roughly almost 1 million higher than what it was today. When home sales crashed from 2005 to 2007, that 2.5 million went to 4 million. We did not have that happen here. The whole concept of my team higher rates in February of 2021 is like, we need higher rates. Don't worry. This is not the housing market of the housing bubble years. You don't have to worry about forced credit sellers or anything like that. But we have to get inventory up because we can't have a functioning housing market when active inventory is just too low of active listings. And we're getting there. We're getting back to normal. But I think the supply and demand equilibrium of the tracker is what I really want to teach. Because if rates keep on going lower, if hypothetical, and the data starts to get better, you're not going to see this for months in the existing home sales report. And what happened last year, which was the funny part, is because when I challenge Doomers and they tell me their forecast, they have a 5% decline in 2024 and a 12% decline in 12% decline in 2025. They have a cumulative 19% decline, which is literally the biggest housing price crash since the bubble, but it happened in a short duration time frame. They're copying the first 2 years of the housing bubble. My God, I can't believe how amateur that is, but they're literally copying the same data from back then. In any case, I asked the individual, I said, so what in the data that's telling you this? Well, they say the price cut percentages are rising. And I said, okay, then why is the median sales price still rising? This is the whole Redfin debate we're having. Right. Why did Redfin go doom porn? Because they wanted attention. They got attention. And yet every week after that, they're like, oh my God, home prices at an all-time high. And it was like, wait a second, you told us that Logan was right about us. We wanted people to read the data. So there is an equilibrium. In that equilibrium in the tracker, you could see what happened in 2022, the slope of the curve of the price cut percentages. Whoo, Nelly, that was hot. That thing just we went from 3% mortgage rates to 7%. That was a drastic. The slope of the curve is it's rising, but it's not as fast. Right. So I think I was one of the lowest price forecasters of the year at growth at 1.77%. But I based that off of our slope of the curve of how I think housing is going to work. Not being a mortgage rate lockdown person, it makes sense. So that's why I like to teach to tracker, because if all hell was breaking loose, man, that slope of the curve would look like 2022. Right. right? But it's quite not happening. And just the last 2 weeks, you need a lot more confirmation, but just the last 2 weeks, things have slowed down, right? The inventory growth has slowed. The price cut percentage is closed. The weekly pending home sales have picked up a little bit. And the purchase apps are now working off of 8 straight weeks of double-digit year-over-year growth. That's how you formulate a live model for people to see. And when they visually can see it, because if things start to get stabilized and a little bit better, you'll see it in that data line. And then 3 months down the line, it'll be in the existing home sales report. Like last year, it was like, oh my God, where do these couple 100,000 home sales come from? What happened? Purchase apps weren't growing year over year. And it's like, nope, they were getting better. The weeklies were getting better. The pending home sales, like our pending home sales really got better last year toward the end of the year. That's why I knew my price forecast was going to be wrong last year. I was going to be too low. So we teach it this way so we don't have to wait 3 months. Like some of these poor individuals that are sitting there thinking, oh my God, home sales are crashing. I'm like, really? Really? Where is it? Where is it? And they're like, oh, you don't track housing, do you? You're just reading headlines. It's okay. Don't worry about it. There's like a ton of people like you over there. So let's move along. Get over there. Get over there. Too old, too slow, not athletic enough, not talented enough. There you go. Get back in there.
I love the way you taunt people. It's very funny. Okay, so I think one of the other things that you just mentioned, but it's really important, is the last couple of years you've had to be like, it's like February, it's like March, and you're like, we're done. I mean, that was the peak, and this year we had so much more. It lasted so much longer. Now, still to your point, still low, but how do you think about this year? I mean, in comparison to other years, as far as like how long we were still selling homes.
I love 2025. If I had to take back the last few years, 2025 is my favorite year because it's a balance year.
Yeah.
Considering how high home prices are, taxes, insurance, and rates, for us to be able to grow inventory. And one of the things we wanted to teach back in the old days, you used to have rising inventory and rising sales, right? So I could explain if home sales pick up a little bit with rising inventory, because that's kind of how it used to be. And when you're working from extreme low levels, you can get something like that. That's what I call the chef kiss. This is why I love 2025. Like I've got purchase apps growing double digits. I got inventory getting back to normal. I got price cut percentages elevated to cool pricing. It's starting to become a buyer's market. This is what I've wanted for years. It's taken a little bit longer than I thought it would, but still, this is what you need for years and years of sales growth. You cannot have 2020 and 2021 and the early 2020. No, it was the biggest vomiting puke housing market out there because it was so much forced price inflation because of the shortfall of active listings. You don't see that anymore.
Yeah.
You don't see that. And that's the most beautiful thing about 2025 for me. So I am very, very happy about what's happening this year. And the fact that you have mortgage demand. Remember what people said, stocks are down 20%, tariffs, all this crazy headlines, jobs are being lost, governments, all this stuff. Who's going to apply for mortgages? Remember COVID? Everybody's like, oh my God, Logan, there's 25 to 30 million people unemployed. I was like, yes. And there's 5 million in forbearance. There's 35 million people off the grid. Who's going to buy these homes? And what do we always say at every conference, at every meeting, everything? My army's bigger than yours.
Right.
I had 133 million people back in COVID working, getting paid 3% mortgage rates. As soon as they think they're alive, things get back to normal. Here, I have 162 million people sitting, waiting for rates to go a little bit lower. And even with elevated rates, taxes, insurance, and stocks, and trade war tap dance, and everything, mortgage buyers, Americans, right? Badass American people who don't sit there and watch doom porn every time, they filled out because they feel like, hey, it's okay, right? And just a little bit of growth. And like I said, it's a little bit, I wouldn't have taken this bet to have this kind of purchase application data with rates above 6.64% most of the time. But if rates go down, I really want to see, does the weekly data firm up a little bit more? And then you get that double impact. If it is, then I have to be mindful. And am I going to be wrong again on my price forecast? Am I going to be too low again? And this is why I want to train people this. So last year, we tried our best to kind of get people, no, home prices aren't going to fall 5 to 12%. Everyone's doing it. No, and we want to untrain the fanatics of this world, get them back into the real world, and just leave the few crazy people left by themselves so they could scream about whatever until they're dead. And in the afterlife, I'll join them in battles in hell forever. But for now, we can teach the living, how to do this. And it's so much fun. It's so exciting. But the last 2 weeks, for those that can read the tracker, you can visually see this. It's a little bit different. But we'll have to wait 2 weeks after the July the 4th things and see where we are. And we'll see where rates are. Yep. At that point. We're getting to the point to where we're going to need to see weaker economic data to start pushing this a little bit lower. We're getting closer to that, the bottom end range of the forecast. If that happens, you need validity to take us lower in that.
Well, we're going to be talking to you all week because it is jobs week. So we'll be not on July 4th, but actually on July 4th, there will be an episode with you. It's the next Monday that we don't have it. But anyway, super excited. Logan, thanks for walking us through this. We will be talking about jobs and what the labor data means for mortgage rates next time I talk to you.
Yes. And always remember, starting next week, 4 times a week.
4 times.
We're getting the chart daddy up. And again, our job is to teach. We're teachers out here. So that's how we look at it.
Amazing. Thank you so much. Talk to you soon.